for credit strategy is something we started back 15 plus years ago. And that's a strategy that we believe is going to be sustainable as long as Peachtree exists as a firm. We will be investing in credit.
Hello, everyone, and welcome to another episode of What's the Alternative? My name is Shana Orzik-Sissel, and I am the founder and CEO of Bond Capital Management. Today, I have with me Greg Friedman, who is the managing principal and CEO of Peachtree Group. And Peachtree is one of our newest partners. I'm really excited about working with Peachtree. Our initial response from our advisors and our network has been overwhelmingly positive. So I'm excited to have Greg on the show. For background, Greg is the founder of Peachtree Group and has successfully overseen investments of approximately $100 billion in commercial real estate and various other enterprises. He has over 24 years of experience in the space, bringing extensive credit and equity investing expertise, particularly in hotels and other commercial real estate assets. He's formerly the senior vice president of business development for Specialty Finance Group, where he originated more than $2 billion of credit transactions. He is a graduate of the University of Texas at Austin's Hookham. Wait, I did that wrong. Hookham.
Yeah.
And is a board member of the almost right. And is a board member of the American Hotel and Lodging Association. He also serves as a real estate fund advisory board for the Texas McCollum School of Business at UT Austin. Welcome, Greg. Thank you for being with us.
Yeah, thank you, Shana, for having me. I look forward to talking to you today and really appreciate what you and your team are doing with us as we're out, continuing to, raise additional awareness for, the different strategies that we have.
And I apologize for screwing up the Hookham part. I know that. I have friends that went to UT Austin, so I should know better.
Don't worry about it because it's I'm a huge Texas fan, so I'll forgive you on it. But I'm also a huge Alabama fan, so I grew up outside Tuscaloosa, so I'm a huge Bama football fan and huge Texas football fan and basketball fan as well. So.
Well, that must be interesting during the season when they play each other. I had a friend that went to Iowa and Northwestern, similar kind of thing. He always, when they played each other, he would always say, like, I can't lose. So I get it. I went to UMass Amherst. We didn't have football that was worth watching.
Yeah, I can appreciate that.
So I wanted to start off by chatting about your background. Obviously, you have an extensive experience in commercial real estate. Tell me a little bit about how you got into the space and what makes you so passionate about it to the point where you felt like you wanted to have your own firm focused on investing in the space.
Sure. So personally, I grew up in a family that owned a lot of commercial real estate. My family owned some hotel properties. And they were big on the lending side as well. They, my grandfather originally got one of the first non-bank SBA licenses that he utilized. And this goes back in the 70s, but he ended up utilizing this license to finance a lot of hotel projects, as well as other types of properties and other types of businesses. But he financed a lot of hotel properties through that, through that business. But with that being said, personally, I grew up around, real estate. I grew up around, the credit and lending side, and then went to school, as we sort of talked about before. I went to school at University of Texas at Austin. And when I graduated from Texas, I actually went into banking. And, through that, when I was on the banking side and actually, helping finance and capitalize, commercial real estate projects and hotel projects, that's when it, really became super passionate about the space and the desire to go out and, start my own company. And that's where I met, my partner originally was back when I was out, financing primarily hotel projects. Had met him through some mutual friends, and we actually did, professionally did some business together. And that's, that was the initial, impetus for us starting, Peachtree as a company back in 2007.
So you guys have been quite successful. Whenever I mention Peachtree to any of the advisors in our network and in our pilot program, they always get really excited because you have such a great reputation. You primarily, correct me if I'm wrong, started mostly in hospitality. So what what is it about the hospitality space that's so unique? You don't run into that as often as some of the other sectors. And I'd be curious to see why that is the most attractive sector to kind of start off with when you started Peachtree.
Yeah. So it's, part of the reason it was most attractive is it's a very heavily dislocated space, no matter what's happening, because it's got an operational component. It has a real estate component. So you can find a lot more mispriced risk historically within the hotel space, and that can cut both ways. But, we've done a really good job being able to find mispriced risk for the benefit of our, stakeholders and investors and so forth. And that's the reason why we thought it was very interesting at the very beginning. Not to mention, we had a lot of experience and just institutional knowledge from just our backgrounds. Because, as I stated earlier, personally grew up around the business, and the same for my partner. So we had, really an understanding of how the business operated, both personally and professionally, for starting Peachtree. And back in 2007, when we were buying assets and looking to, start the business originally, we were, started the business more as a personal investment vehicle for myself, my partner, for like my parents and grandparents and aunts and uncles and so forth. And same for my partner. We found that to be the space that seemed the most compelling at that moment. And it actually worked out for us because our, I call it our legacy investments, our investments we made, pre-great financial crisis, they actually worked out well, because we ended up generating probably, very outsized returns relative to what other groups, that invested capital pre-GFC, what they generated on their, real estate side.
So what do you think is the key to like finding the right opportunity and the value there? And how do you create value in a hospitality investment? So I'm assuming that, the property is the property, but the way that you can really turn it around and add value is in the operational stuff that you were referring to. So what does that involve?
Yeah. So the hotel business is, it's complex, but it's somewhat simple too. So, it's all about putting heads in beds. It's about putting heads in beds at the right, pricing. So revenue management is a big component to it. And the reason I say that is a lot of times you'll find the hotels we buy, the reason that it's compelling for us to buy that asset is that it's being misoperated from a revenue management perspective. So, a lot of cases we can drive higher rates. And when we drive a higher average daily rate at that hotel, so if we're charging $300 a night versus $200 a night, that extra $100, it doesn't cost us anything extra to service that guest. So that extra $100 typically flows, majority of that flows to the bottom line. And when I say the majority, probably, 80% plus flows to the bottom line. And so it's, the hotel becomes even more profitable, and you're able to really drive your NOI, your net operating income at that asset. So it's very much a business where if you understand the revenue management side, you can, usually find a lot of just assets that are not, being operated correctly. The other component that we find interesting when investing into hotels is hotels require, CapEx every, call it 5 to 7 years. So they are very CapEx intensive, and they're very brand dependent, meaning the brands, to be successful in the hotel business, it's our belief, you need to be tied into the major brands, because that's your distribution. And so those two components of, constantly needing to put CapEx back into these assets, as well as, the ability to find value by converting to better brands, that's where we've also found a lot of compelling opportunities. And for instance, we buy a lot of assets that need major renovations in order for that asset to, once again, become competitive with the other properties that are within its submarket. So we'll buy maybe we'll buy a, Hilton Garden Inn hotel that's hasn't been renovated for, 7 or 8 years, or maybe even longer in some cases. And we'll go in and perform that renovation. And once we do that renovation, we're able to charge much higher rates, much higher average daily rates. And we're able to drive more occupancy into the hotel. So we're able to drive, better top line revenues, as well as ultimately that, leads to, more net operating income. And so we found a lot of success doing that. And along the way, as we're doing these major renovations, what we found is, we found a lot of assets that are just misbranded. You may have a independent hotel that isn't achieving its optimal performance. And part of the reason it just doesn't have that distribution. and we'll go in and buy an independent hotel and convert it to one of the major brands. And we've had a lot of success doing that, as well as even buying hotels that are branded, a lesser brand, or a brand that doesn't have as good of, traction in the marketplace, doesn't have as good distribution from a standpoint of being able to drive reservations into that, hotel, and we'll convert to like a Marriott or Hilton brand. And we've driven, a lot of value, by doing that for ourselves and for our investors.
I totally appreciate that. As a Marriott Bonvoy loyalist, and prior to that, a Starwood loyalist.
Right.
I literally, no matter how much the nice boutique hotel is in a certain locale, I will stay at the slightly less nice hotel if it's in Marriott Bonvoy's network, just because I have gold status there and I can get later checkouts. And I get all these perks, and I want to keep my status. And for me, I just know what I'm getting and what to expect when I am staying someplace that's associated with Marriott, or some people are like that with Hilton or Hyatt. I just tend to your point, stay with that. The boutique hotels often are extremely nice, but when they don't have loyalty programs, and they tend to be more expensive for somebody who travels a lot, especially business travel, it's just not worth it. It's just not. And so I totally understand the point that you're making there. It's just the expectation for the service and the quality and what the rooms are going to be like. You know what you're getting, and then you get the perks of being a loyal customer. And if you're a frequent traveler, that's what you focus on. You don't focus on, the little things that maybe a boutique hotel does. The only time I ever stay in a boutique hotel that's not associated with a brand is if I'm speaking at a conference and the conference organizer is having it at that hotel, and I just don't really have much say in where they make my reservation. But most of the time I say based on your brand loyalty. So I totally appreciate what you're saying. And I think a lot of the larger brands have started these boutique associated autograph hotel, or whatever they're calling them now, which I think is great for the smaller independent operator and folks like yourself, because there's clearly a focus there on being able to provide like a unique experience.
That's right. And the brands are so critical. And that's one thing I've seen too many times. People think you can invest into the hotel business being an independent branded hotel in a secondary type city, because, the independent hotels can work in some of the primary markets. It is very tough to have to either start a new brand or have a brand that's not backed by one of the major brands like Marriott and Hilton, because they have such strong distribution. And to, make money in the hotel business, as challenging as it can be because it's an operating business, it's somewhat simple. You just got to put heads in beds. You got to control expenses. So that means you got to have you have to have a good, brand that's delivering reservations. You got to have a good local team that's doing, the sales, the local sales, localized sales, going out and talking to, local accounts, corporations or other groups that are looking to stay at the hotel, and have that brand helping drive the reservations, which is driving revenues into the asset. And the operator needs to be able to go in there and really have discipline on the, cost side. And then, the other components matter too, like location. Location probably matters more in the hotel business than, a lot of the other property types, just given the fact that, that's in most cases that serves as a billboard. It's the ease to get to, for the guests to get to the hotel. And a lot of guests choose staying at one hotel over another if it's closer to, why they're going, visiting these, different cities or in different parts of the country or parts of the world, or if it's, if it's easy to, get access to that property. So it's a, pretty simple business. And then, as people are making investments in hotels, the one thing I would add is basis is super critical to have. We're big believers that you got to be at a sustainable basis in order to, make money in the business. So we're always looking at what is our basis relative to, comps in the market, what is our basis, relative to, replacement costs and things like that as well. So it's all comes down to basis, brand, location, and, just the operational discipline as well.
Now, in the last decade, we've had some disruptive forces in the hospitality space as it relates to, vacation rentals were always the thing. VRBO has existed forever. But when Airbnb came into the market, it set up and marketed itself as a alternative to hotels. How has the hospitality investing part of it kind of changed in the face of these new differentiated entrants? And how do you kind of ensure and how you can compete against these? And because you're kind of offering two different value propositions, but in essence, it in the same way Uber kind of disrupted cabs, how is like a Airbnb forced hospitality investing to change and evolve?
It's a great question. So, when Airbnb first came out, everyone thought Airbnb was gonna do exactly what Uber did to the taxi space, and that turned out to not be the case. Clearly Airbnb serves as a niche, but it did not disrupt the hotel space. It didn't, disrupt, or at least it didn't disrupt the hotel space from the way people thought, where it was going to pull all these, occupancies and really impact the top line performance of hotels. What we found is that Airbnb, where it has impacted hotels or had some disruption, is really on nights where we're already selling out. So it's the nights that we're running 100% occupancy. Well, if all of a sudden the Super Bowl is coming to Atlanta, Georgia, where we're based out of, the Super Bowl is going to be there. Well, guess what? Historically, if we were able to charge, $2,000 a night, well, all of a sudden a guest is looking at paying $2,000 a night to stay at a Marriott Courtyard, and I'm just making up something here, but they're going to be like, okay, well, I can stay at this Courtyard for $2,000 a night, or I can go rent an apartment and get 2 or 3 bedrooms, and we can pay $2,000 a night doing that. Well, the person that owns that apartment, or the person that's renting that apartment, that's going to now put it on Airbnb or whatever the case may be, or rent their house, well, they're not willing to do it on a traditional night, because traditionally that Courtyard is only renting for $200 a night, and they're not willing to rent their house or their apartment just to make a couple $100 or maybe even less than that. But they're willing to do it during the Super Bowl because they're getting this outrageous rate. And so you see this phantom supply that comes in and exists that will disrupt our ability to drive rates on these special events. But it's even that effect has slowly evaporated, because I think what most guests have seen and what we've witnessed is that most of the guests that stay at our hotels, which are the branded hotels, they're staying at our hotels because they like the consistency of service, they like the ease of booking, and the major brands have done a good job of maintaining that consistency, with the quality across the different types of brands, or the different types of properties within those brands are very consistent. So exactly what you're going to get when you show up at a Marriott Courtyard or Hilton Garden Inn. It's very easy to book it through the apps. So it's much easier doing that versus trying to book an Airbnb, and you're showing up at someone's house or someone's apartment and you don't know what to expect, and you don't know what amenities that you have. And our guests traditionally at our hotels are usually a lot of it's corporate travelers, or travelers that are traveling for a couple of nights max, for 1 or 2 nights, in some cases maybe 3 nights, but they want that consistency. They don't really want to deal with the challenges that Airbnb a lot of times can create.
As somebody who uses both, I think for me, it comes down to, I use Airbnb if I'm traveling with my son and family, because if we all want to stay in the same place, it's harder to do that in a hotel, because most hotels don't have true 1-bedroom suites where you can close a door when your kid goes to bed at 8 and you want to stay up. But for the most part, I would choose a hotel 9 times out of 10, because I don't also want to be the maid, and I don't want to pay an exorbitant fee for a security deposit and cleaning fees and weird, very early checkout times and very late check-in times. So there's so many different parts to that, but I think it's really interesting the impact Airbnb can have on just occupancy availability, especially in smaller towns that may only have 1 or 2 hotels. When there's an event or something of that nature, and occupancy needs to expand to meet demand. And again, that takes away some pricing power. So that makes a lot of sense. When you look at how Peachtree has evolved over time, you started doing hospitality. Obviously, that's your area of how you kind of got involved in real estate. But Peachtree has evolved into having all kinds of investments in real estate, commercial real estate, and related areas. I'd love to hear from your vantage point in a world where the average investor, the average client of the advisors who work with Bonrian, when you say real estate, they immediately think residential because that is that's their world. Everybody needs some place to live. And when you think commercial, there's all this doom and gloom about office space and things of that nature. But I'm not sure that people appreciate just the nuance to the different sub-industries and subsectors within commercial real estate. So as you look at the landscape of opportunities today, what areas are you most excited about that you think that the average real estate investor or the average advisor should be aware of as a potential place where they should be looking to allocate capital if they are looking to allocate capital to real estate today?
Sure. And just to, one thing to back up on us as a firm, a lot of people know us for hotels, as you mentioned, but since 2010, we've invested, very heavily through all property types. We've invested, during the great financial crisis, very heavily through credit across, hotels and other commercial real estate assets, bought a bunch of loans from banks and so forth. And, throughout time, we did a lot on the credit side, through, all commercial real estate. And we've continued to grow, our ability to be very diversified across, real estate is, when I say real estate, commercial real estate being more, multifamily, retail, hotels. We don't do a lot in office. We have very little exposure there. But as you pointed out, a lot of people tend to, when they hear that commercial real estate, they hear office. But hands down, I would tell you right now, the most compelling place to be within all of commercial real estate and candidly all of real estate, because I think everything that's happening today, it's the same impact within real estate. You could argue it's some of the challenges even in the public markets if you're investing fresh capital there, is that we're in this world where intrinsic values of assets have dropped substantially more than where the market is actually, where people are willing to transact and where people are buying. So in most cases, what we're seeing happen across real estate, and this has nothing to do with the actual underlying fundamentals of the performance of these assets, it has to do with just the transaction market. So the intrinsic value is lower than where the market value is for a lot of these assets. So in this type of scenario, we should all be net sellers theoretically, right? Like it's hard to be a net buyer in that world. And so it's hard to have a macro view of saying, hey, let's go all in and buy a bunch of multifamily properties or hotel properties today. You really have to take more of a rifle shooting approach across all of real estate. I think there is as much negative noise that there's within office, there is a bifurcation occurring there too, where 90% of the vacancy issues, and really 90% of the vacancy, not even the issues, 90% of the vacancy exists in 30% of the buildings. So 70% of the office buildings are actually good assets. They're just getting challenged by all the noise in the marketplace with basically debt costs and risk premium spreads blowing out. So with it all being said, this value issue is the real challenge in real estate. So the real opportunities, if you're investing through equity from our standpoint, no matter, there's not, necessarily one asset class where I would say back up the truck and go, buy up these assets, because they all have the same issue right now where, the pricing, is really mispriced risk to, from a standpoint of not being a buyer because it's just too risky in a lot of cases on the equity side. But where it is compelling is investing through credit. And that's why us as a firm back in 2022, you go back to the first quarter of 2022 and towards the end of 2021, we started telling our investors that, hey, we're going to, because we've always invested, because our firm, we're very big on both equity and credit. And we've, invested heavier through credit when at certain periods of time where the market is less interesting on the equity side, and we'll invest heavier in equity when things shift there as well. But we haven't seen that shift on the equity side over the last 3 years. And candidly, I think this year is another year where we're going to continue to see that disconnect in values. The only difference is you've got a huge wall of debt maturities that are occurring, this year, and it's going to go into 2026 as well. And as rates stay higher for longer, even if you see some dropping of the federal funds rate, we really think the long-term rates are going to stay higher. That's going to continue to create pressure on, where market is viewing values versus the actual intrinsic values of these assets. So you're going to effectively, if you're transacting in this market, for the most cases, you're overpaying to buy assets. And so you have to, to find value, you either got to rifle shoot or find special situations, or you've got to focus on a credit strategy like what we've been doing, where we're doing direct lending or buying loans from banks looking to deleverage their exposure to commercial real estate, where we're financing 60, 70% of the current values. And we're still, even at that level, you could argue, well, the 60, 70% of the current market values of these assets, well, the intrinsic values are still lower, but they're not, they're lower by maybe 10% of the market value, not, by 30 or 40%. So we're still at a very nice discount to the actual underlying intrinsic values of these assets. And effectively, we're able to generate outcomes that are very similar on the investment side to what we would, what we see traditionally on the equity side. And I just think we've entered a period, we've gone through this period of really overperformance within commercial real estate on the equity side due to, pre-2022, we had this 12-year run where we just had 0% rates and we just had this compression in cap rates, where risk premium spreads compress. And now we're on the other side of that trade. And the market is very confused right now. The market is dealing with, the new administration. I think there's a lot of positive, positive initiatives by the new administration that's going to benefit at the asset level, the performance of assets, but it's still, this balance sheet issue is not going away that we're talking about right now. And, there's a lot of just broken balance sheets within commercial real estate. And that's going to be, what's going to create the special situations, but it's also going to create the scenario where it makes more sense from our viewpoint in general. If you're going to invest, a lot of capital into real estate today, it's almost better to do it through credit.
So what's the catalyst to see these issues turn from headwinds to tailwinds?
Yeah. So I think the biggest catalyst is just this, wall of debt maturity, because that's because when people aren't forced to transact, then, nothing happens, right? Like that's what we've seen,
Right.
Extend and pretend was what was used during the great financial crisis. It's what's been used historically when we have market disruptions. You see a lot of extend and pretend, a lot of, groups when I say groups, a lot of lenders try to, work out their book through extend and pretend. This time around, the difference is, when you typically have market disruptions, we go from, having higher rates to having substantially lower rates because the Fed comes in and just drops rates to zero, like we saw during the GFC. Well, extend and pretend works really well in that environment, even when asset level performance is underperforming, because it costs you very little to carry these assets for a period of time until performance can catch back up. The difference this cycle is extend and pretend is really tough when you have negative leverage across a lot of these assets, and you're having to pay a lot of money to continue to carry these assets, or you're going to have to inject a lot of liquidity to right size these assets. So it makes it very tough to continue to extend and pretend, which means effectively, there's going to be a lot of forced transactions. You're probably going to see, more note sales this year through, different lenders that are looking to not have to deal with these issues anymore with extend and pretend. If it's, banks, if it's private lenders, you're going to see more note sales there. You're going to see, a lot more, opportunities where groups are selling assets, and they're either going to have to sell it in a more structured format where, maybe they take on a partner that injects like preferred equity, and they get, some type of, equity participation in addition to a return on their capital, or they're going to be buying assets and providing hope notes and things like that. So I think it's going to be a very constructive environment this year. It's going to require a lot of, creativity, I think, to, for the next 12 to 18 months. But it's also going to be, I think to your original question, the catalyst is this wall of debt maturities across all of real estate. And then across certain assets, you have other challenges and issues that are, depending on the asset class, that will be a catalyst. Like, for instance, within hotels, you just have this, this lack of CapEx reinvestment. CapEx reinvestment since the pandemic is down, close to 50% from historic ranges. So there's a lot of assets that need to renovate their assets to maintain their brands. And that's going to be another catalyst that's going to, really help drive asset sales and start creating, where, groups are going to be forced to make decisions. So I do think 2025, 2026 will be you'll see an increase in transactions, but it's not going to be, I don't think you're going to be seeing necessarily, large portfolios trade. I think it's going to be a lot of these one-off trades that are going to occur this year that are going to start, being in a more constructive or special situations type environment.
So whenever we talk about real estate, no matter the type, we have to talk about geography, because that has just as much influence on values as anything else. So, we all know during the pandemic that there were certain geographies that benefited and some that did not, for a variety of reasons. As we kind of have gotten through that, and now we're kind of moving into a different era of real estate and where people want to be, people having to return to office, which, as I've learned recently, means that some moving that happened during the pandemic when people could work from anywhere is now forcing them to move back to areas that had seen a lot of population leaving. So in your experience, because you have such a vast portfolio of different types of real estate, are there any geographies that are underappreciated where you're finding attractive opportunities?
There's not, I would say, from the most part, I wouldn't say that there's any specific markets I can think of right now that I think people are missing. I think with technology today, when people find out that there is a market that, is all of a sudden experiencing a lot of, growth or experiencing outsized performance, you quickly see, through social media, through technology, people can quickly identify it and take advantage of it. And that's why, you do need to have very strong operating discipline, as well as, just discipline when acquiring assets and looking at, especially within the hotel sector. So we've been talking about hotels so much today, really identifying what's driving demand, because there was a lot of markets, if anything, there was a lot of markets that became very interesting during COVID. But we found some of these markets didn't sustain because, it was really benefiting from this growth of leisure demand when people, weren't required to go to the office. They could work from home. And now, to your point, they're moving back to some of those areas. So now they're not traveling as frequently, for those leisure reasons. And so markets that were fully reliant on leisure demand and had, limited demand, maybe, pre-COVID, or limited, demand growth that, is now starting to go back to its historical levels. And so it's one of those that, as we look to invest capital, we tend to try to stay focused to what our long-term strategy has always been, is focus on markets from a standpoint of, what markets have positive migration stories, what markets have, some level of barriers to entry, markets that, are more business friendly, because those those markets tend to outpace inflation. They tend to, do better, long term. And then for going in, other markets, like for instance, there's some markets in the Midwest that are very, the growth isn't as strong, or, even on the West Coast, there's some markets that we're very cautious about going into, or even up in the Northeast, because they don't have the, growth levels that you're seeing in some other areas. We'll still go in those markets. It's just going to be on a much more opportunistic basis, where a lot of cases we're buying an asset at a, just at a ridiculously low price. And so that's a situation where we're buying something at a huge discount to its actual intrinsic value. And if we identify that, we're more willing to invest on the equity side, or even invest through credit in those markets. So we try to be very thoughtful about, where we're putting our last dollar when investing. But historically speaking, we've been much more focused on the equity side in the Southeast, Texas and Arizona, because of, the different dynamics that we talked about earlier.
So I'm curious, if, as you think about the impact of what happened in California and over the last several weeks, months or so, with the fires and the rebuild that has to occur there, that's more than just homes. That's like hotels, that's, daycares and schools and healthcare facilities and things of that nature. Do you think that going forward, that presents a unique opportunity for investors like yourself?
It's interesting. It's going to create demand for hotels. It has created demand for hotels. We have, data on some of the hotels that we have out in that market. We're seeing it firsthand, but that demand is not long-term demand, right? Like that's the artificial demand that you got to be careful, when, making investments in those markets. And what I've found historically is sellers are, wanting to get paid, usually at a, effectively for that demand as if it's going to sustain through long-term. And that's not going to be the case. So at some point the demands are going to normalize out. So I would say there's no question there will be opportunities out there, but we'd probably be very cautious in how we approach, that market. And but if anything, the other part that you didn't mention that I find interesting is just insurance costs. I mean, it's gone. The expenses just continue to increase, and it's going to continue to be very challenging to get insurance, especially out in California, in that LA market. It's going to continue to be challenged, and it's going to make it harder for owners of assets to sell assets, and it's going to have potentially a negative impact to some of the values out there as well. So I mean, it's not a very easy question to answer, just because there are a lot of components, and you've got to be very thoughtful. And I find within real estate, even in other spaces, people tend to, quickly get excited about something. And I'll use data centers, like all of a sudden everyone's raised a bunch of money to go do data centers, and data centers make a lot of sense. But then all of a sudden, you have DeepSeek, all of a sudden brings in question if we even, how much data centers do we actually need? And I'm not a tech person by any means. We had trouble getting on this today. So, firsthand, I'm not the most tech savvy person, but the point is we tend to try to, we always look at trends and what's happening, but our question is how sustainable are these trends? And we want to find, strategies that we identify that we feel like are sustainable long-term. Like our credit strategy is something we started back 15 plus years ago. And that's a strategy that we believe is going to be sustainable as long as Peachtree exists as a firm. We will be investing in credit. It's just at certain points we'll be investing close to 100% of our capital, and at other points maybe we're investing less because it's just not as interesting and it's more challenging to find good investment opportunities on the credit side. So we tend to try to create programs that we think are sustainable long term versus falling into fads or trends that may or may not sustain. So.
Now, I know you have some products at the firm that are real estate adjacent, not necessarily real estate. When you think about how you've kind of branched out, what is the area that you think is most unique and interesting, especially I like to talk about ego investing and value investing, especially as it pertains to individual investors that traditionally work with financial advisors like the ones that work with Bonrian. Is there something you're doing that you think particularly plays into that space of ego investing, where it's just a really unique thing that you want to associate yourself with in that kind of ancillary space that you guys play into?
Yeah. So it's funny. We have this question a lot, and candidly, we've made a lot of money based on people investing for the ego reasons. Like I tell everyone, we invest for IRR. We don't invest for ROE, return on ego. So I find a lot of people jump into the hotel space, because they want to own a nice luxury hotel, or they want to own a hotel property. They want to be the hometown hero on a hotel, on a restaurant. And they turn out to be, in a lot of cases, really bad investors or bad investments for these investors. Because they're investing for the wrong reasons. We have a film finance business that we get a lot of questions on, and it's really a receivable finance business. It's not, it just happens to be that we're financing the production of movie films. But what's happening is we're actually going in and financing the pre-sales on the distribution rights of these films that are being made. And typically when a film is made, certain investors will just invest into the film without any pre-sales. They're taking on that creative risk. We're not willing to take on creative risk, meaning we don't want to have to question if the movie is going to have any box office sales, if it's going to have any, buyers like a Netflix or whoever, or Amazon is going to buy it at completion. We want to know on the front end who's buying these films. And then we're also taking, as we're making these loans to these films that are being produced, we're getting a pledge of these, agreements where, someone's pre-selling, this movie. We're also getting all the tax credits, because a lot of these films are being made, here in the U.S., like in Georgia, has a huge tax credit program. Kentucky, we've financed several films over in Australia, has a great one, and we're getting that as additional collateral against our loan. So on the surface, it looks very ego-driven, but once you start to realize what's really happening, it's mispriced risk to the benefit of investors, because we're able to, to go in and basically provide a senior loan. So we're attaching usually at, call it 70 to 80% of the total production cost of this film. This film will have a bond in place to effectively guarantee that the film will get completed. So we take away the production risk, and we take away mitigate a lot of the, creative risk by having those pre-sales and tax credits as collateral on our loan. And so, we feel like it's mispriced risk because we're able to generate really really good outsized yields to what's really happening. And, it's asset backed. So.
Very cool. Film financing and film funds are definitely one of the areas that we've seen interest, particularly from that ego perspective. So I totally can appreciate that. The story, it's like sports rights funds in that way. It's sexy. But I want to thank you for your time with being with us today. As I stated, we're really excited for the opportunity to work with Peachtree, and I'm excited because we've started off so strong already with our advisors, just loving the products that you bring on board. Most of your products are available to custody at Fidelity and Schwab, which is a huge win. And all the feedback we've gotten so far from the advisors you've met with that we help facilitate has been overwhelmingly positive. So we're super excited to work with you. Thank you so much for joining the show today. And I just want to thank everybody for tuning in. Please make sure to like and subscribe if you like this episode. We're always looking for ideas. If there's somebody or something you want to hear about, please let us know. And until next time, I am Shana Orzik-Sissel, founder and CEO of Bonrian Capital Management, and this is What's the Alternative?
Let's go boom.
The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Bonrian Capital Management's platform. As such, Bonrian may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Bonrian Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Bonrian Capital trademarks mentioned are owned by Bonrian Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.